All right, let's dive into one of the most important chapters from an absolute classic of investing, Benjamin Graham's The Intelligent Investor. We're going to tackle Chapter 2, which is all about a force that's constantly and quietly working against your money, a force Graham called the silent thief, inflation. So let me ask you something. You log into your investment account and you see it's up 5%. That feels great, right? Of course it does. But here's the question Graham wants us to ask. Is your money really growing? Is your wealth actually increasing? The answer, you'll see, is a lot trickier than it looks. And the reason it's tricky is because there's this villain working in the background, a sneaky, relentless force that's always trying to chip away at your savings. Graham's name for it is just perfect. He calls inflation the silent thief because it can rob you blind without you ever even hearing it coming. So what are we really talking about here? In the simplest terms, inflation is just stuff getting more expensive. You know how the price of a coffee or a gallon of gas just seems to creep up year after year? That's it. That's inflation. And it means that every single dollar you have buys a little bit less today than it did yesterday. And this idea, what your money can actually buy, is everything. It's not about the number of dollars in your account. It's about their power in the real world. Let's make this super clear with a quick example. Okay, imagine you have $100, a nice, crisp $100 bill. You take it and you tuck it away somewhere safe for a year thinking, perfect, my $100 is safe. But here's the catch. If inflation is running at just 3% that year, your $100 can now only buy what $97 could have bought when you first put it away. The bill is still there, you haven't lost any money, but you've lost purchasing power. That's the silent thief's handiwork right there. And this distinction is the secret decoder ring for smart investors. You've got the nominal return. That's the big, flashy number your brokerage account shows you. Hey, you made 5%. But then you've got the real return. That's the only one that truly matters. It's what's left after inflation takes its cut. So if you make 5%, but inflation was 3%, your real, actual gain in buying power was only 2%. So knowing that, where does this thief like to strike most often? Which of your assets are in the biggest danger of having their value slowly eaten away? Well, you might be surprised. Graham points his fingers squarely at the two things we're all taught are safe: cash just sitting there in a bank account and fixed income investments like bonds. It's kind of ironic, isn't it? The very places people run to for safety can actually be a trap when inflation is on the move. And the reason why is actually pretty simple. The interest you get from a savings account is fixed. The payment you get from a bond is fixed. If the cost of everything else in the world is rising faster than those fixed payments, you are guaranteed to be losing purchasing power. You're actually getting poorer every single day. So, if cash is a leaky bucket and bonds might not be much better, what's an investor supposed to do? Well, Graham suggests we look toward equities. Yep, stocks, as our potential shield against inflation. And this chart just lays it all out, doesn't it? Historically, after you account for inflation, cash has barely kept your head above water, and sometimes you're actually sinking. Bonds do a little better. But look at equities. They're the one thing that has consistently delivered strong, real returns over long periods because you own a piece of an actual business, and businesses can raise their prices to keep up with costs. But, and this is a huge but from Graham, he is not telling you to just blindly pile into stocks. He's very clear. They are an imperfect shield. There is absolutely no guarantee. Stock prices are volatile, they involve risk, and they demand a thoughtful, disciplined approach, not just wild speculation. So let's wrap this all up. What is the fundamental shift in thinking? The core mindset that Graham wants us to walk away with after understanding this threat? It really all boils down to this one idea. It's not about chasing the biggest number on the screen. It's not about bragging that you made a 10% return. For the intelligent investor, the only thing that matters, the primary focus, has to be on the real-world purchasing power of those returns. So what's our game plan? It's really a 3-step mental checklist. 1. Accept that inflation is a permanent part of the game. It's not going anywhere. 2. Get obsessed with your real return. Always do that simple math. Headline return minus inflation. And 3. Build your entire investment plan around the goal of protecting and, hopefully, growing your purchasing power for the long haul.
And that leaves us with one final and I think really profound question to ask ourselves. A question that gets to the very heart of why we invest in the first place. Are you just playing a game to get a higher score, to see a bigger number on a screen? Or are you investing for what those numbers can actually buy for you, for your family, for your future? The intelligent investor knows the difference.